Well, I'm Larry DeBoer with the Purdue Agricultural Economics Department, and I do the outlook for the general economy, so the big picture on GDP and unemployment and interest rates and all that. Looks like it's going to be another year of slow but steady growth. We're about 6.5 years into this expansion since the end of the Great Recession, and we've been growing between 1.5% and 3% per year during the whole time, which is one of the slowest and steadiest expansions we've ever had. Looks like that's going to continue. Consumers are spending more, about 3% more this year than last year, and they've got good reason to spend more with the labor market improving and home prices going up, and consumer confidence is up as well. Looks like home construction also might help growth continue. The stock of homes for sale is still small, and home prices are rising, and that should be good for home construction. So those are two things that are looking up. The things that are not looking up are the rest of business investment. Capital goods orders are down. Government purchases from both state, local, and federal government are kind of a drag on the economy as well. And the rest of the world is not in very good shape. Europe is growing slowly. China is growing slowly for China. Japan and Brazil are in recession, so we shouldn't expect much in the way of investment, government purchases, or exports to aid our growth. So I'd say somewhere in the neighborhood of 2.3% GDP growth over the next year. That kind of growth used to be needed to bring the unemployment rate down, but lately the unemployment rate has been falling even with slower growth. And so we would expect the unemployment rate to come down a little bit. It's already at 5%. Once it hits 5, then it starts to fall more slowly. Something like 4.8%, I'd say, by this time next year. Inflation, we got two different reads on inflation. There's the all items inflation rate, which has grown over the last 12 months 0.1%, but that low rate is due to the fall of gasoline prices. The core rate, they call it, without gasoline prices, is 1.9%, and that's about what it's been for the last several years. And so we kind of expect that to continue, though, as the unemployment rate comes down, as the economy reaches capacity, perhaps wages will rise a little faster, and perhaps a shortage here and there will develop. And so maybe inflation will go up 2.2% over the next year, a little bit faster than it's been. And that brings us to interest rates, and that depends on the Federal Reserve, and it's looking increasingly certain that the Fed will be increasing the federal funds rate here in December. Even if they do, though, the economy with its slow growth and with the exchange rates rising on the dollar, I would think that the Fed will be very cautious over the next year. So perhaps 2 or 3 quarter-point increases in the federal funds rate over the next year, which would bring the short-term interest rates on 3-month Treasury bonds to about 0.75%, and the rate on the long-term bonds to about 2.8%. So those are the numbers that I'm looking for over the next year. And once again, things could go wrong, of course. Europe could blow up again. China could melt down. Who knows how Wall Street will respond to the very first interest rate increases from the Fed in almost a decade. But without any of those, I'd say we're going to see more slow but steady growth for the United States.